Hi, hello everyone. So I wish a good day to all the viewers. So now we are going to have a discussion on taxation of companies. Whenever I say the word companies, what generally usually the people remember is a new tax called MAT. MAT stands for minimum alternate tax. So usually people use it to remember this concept of MAT whenever I say assessment of company. So now whenever there is a company assessment, it may be a private company, public company, one person company, whatever may be. In case of such company, so what are the special points we need to remember at the time of making assessment? What are the additional disallowances, additional allowances, a new tax called MAT, which tax is required to be paid, whether we have to pay normal tax or MAT. These are the questions which arise in our mind. So now we are going to give a solution to all the questions. Why this MAT has been introduced? First of all, how much tax the companies usually required to pay? Those all concepts now we are going to get a clarity. So here if you see the title taxation of companies, number 1 computation of income of companies. Sir, whose income we are going to compute? Company's income. While computing the income of the companies, if you see, I have divided it into two parts. First part is normal tax, second part is MAT. Sir, usually there is normal tax, no? Why again the concept of MAT has come into existence? Here, whether the company is required to pay normal tax or MAT, generally whichever is higher. Why this concept of MAT has come into existence? Because how many adjustments were there? 38 adjustments which were specified in section 115 JB, not 1 or 2. How many adjustments were given? 38 adjustments were specified in section 115 JB. Those adjustments we should have a discussion. Then we can understand why this concept of MAT has come into existence. But before such discussion, first of all, company is required to compute two types of taxes, normal tax and also MAT. How we generally compute normal tax? So generally we have 5 heads of income: salary, house property, PGBP, capital gain and other sources. But for companies there is no concept of salary. So that's why how many heads of income I have given there? Number 1 income from house property. Number 2 business or profession. In business or profession we begin with net profit as per books. We begin with net profit as per books. Out of such net profit as per books, we are going to make some disallowances and allowances which were specified in which sections? Section 30 to 43, which has been discussed in a head called PGBP. Those all disallowances we make and compute the business income. And then we are going to compute capital gains and other sources. These are the 4 heads of income which were available to companies. Out of those we are going to claim, we are going to add them and compute gross total income, out of which we can claim chapter 6A deductions, and then we get a total income. On this total income, sir, are observing, on this total income, which tax the company is required to pay? Normal tax. What is the normal tax for companies? Here if you see, normal tax plus surcharge if applicable, plus health and education cess at the rate 4%. What do you mean by the term normal tax here? Here I have given the clarity. 4 categories I have divided: 30%, 25%, 15% and 22%. 4 tax rates were being given to the companies. These 4 tax rates we are going to discuss now in a detailed manner. Even though from basics point of view 115 BAB and BAA were discussed, here we have to learn, especially company assessment we are going to learn today. That's why in depth manner let us have a discussion. Generally how much tax rate is given? 30%. General tax rate. Any company, what we usually say, what is our tax rate? If they ask how much, we will say 30% generally. But if the turnover during the year 17-18 does not exceed 400 crores, sir, now we are in which year? Now what is the running year? 2021, financial year 2021. That means assessment year 21-22. This is assessment year and this is financial year. So now speaking from this financial year 2021 point of view, the tax rate of financial year 2021 depends upon which previous year? 1718 previous year. 1718, if your turnover does not exceed how much? 400 crores. Then during 2021, what is the tax rate for companies? 25% is the tax rate. Sir, that year the company itself is not in existence, sir. Okay, then in that year what is the turnover? 0. So now can I follow 25%? Yes. Sir, for new companies can I say straight away 25% tax rate? For this year it's okay. What about next year? Every year 25% only, because 1718 there is no turnover to the company. So for all the startup companies, how much is the tax rate can we suggest? 25% we can suggest. So turnover during the previous year 1718, if it does not exceed how much? 400 crores, then tax rate during this year, how much is the tax rate? 25%. So generally 30%, but for all the new companies, how much can I say? 25% is the tax rate. But in these two cases, in 30% and 25%, if you see, in these two cases, I have given this arrow mark below. Along with normal tax, we should also calculate what? MAT also is to be calculated. Normal tax, we have to calculate that 30 and 20 and 25%, whatever may be. Along with that, MAT also we have to compute, and higher tax shall be payable by the company. That means normal tax or MAT, whichever is higher. Why that MAT has come into existence? What are those 38 adjustments? I will give you complete clarity on MAT. Just keep it pending to some extent. So among normal tax and MAT, the higher tax shall be payable by the company. So generally normal tax only should be paid. But in some cases, if MAT is higher, what the company should pay? MAT. Even though the company has paid MAT, the excess tax paid over normal tax can be claimed as credit by the company. For 15 assessment years, they can carry forward such credit. You see, however, if MAT is higher than the normal tax, then excess of MAT paid over normal tax can be claimed as, what can be claimed? MAT credit, and can be used for set-off. This set-off procedure also I will explain you in detail. We are just in basics only as of now. I will explain you in a detailed manner regarding that set-off also. Sir, first of all, generally what is the tax rate for company? 30%. If turnover during the previous year 1718 does not exceed 400 crores, then what is the tax rate for company? 25%. Along with this normal tax, what the company is also required to compute? MAT also. Sir, what is the MAT rate? Sir, on generally I am saying 30% and 25%. No. On what income we are going to compute that 30 and 25%? What is the name of that income? Total income. After claiming deductions, we get total income. On the total income, sir, if there are any special rates, it's okay. Lottery income, special rate 30%. Capital gains, long-term capital gain 20%. Short-term capital gain 311A 15%. Like that, special rates only applicable. On other income, what is the tax rate the company is required to pay? How much the company is required to pay? 30 or 25%. Okay. What about MAT, sir? On total income, we are going to compute. Normal tax. On book profit, we are going to compute MAT. Here if you see computation of MAT, here also we are beginning with what item? Net profit as per books. I am beginning with net profit as per books, plus or minus. How many adjustments were given here? 38 adjustments in section 115 JB. What are those adjustments? We will discuss. But after making the 38 adjustments, what we get? Book profit. On total income we compute normal tax. On book profit we have to compute MAT at the rate. Please remember the tax rate. MAT at the rate how much? 15% plus surcharge if applicable, plus health and education cess at the rate 4%. Sir, here if you see MAT at the rate how much? 15% plus surcharge if applicable, plus health and education cess at the rate 4%. Earlier MAT rate used to be 18.5%. That MAT rate is reduced to which rate? 15% only. There is another concept called AMT, alternate minimum tax, that is applicable for other than companies. Now first we are discussing MAT, sir, and then later we will go for AMT. So first here regarding MAT, generally usually people say MAT tax, MAT tax. Sir, what is the abbreviation for MAT? Minimum alternate tax. T stands for tax only. Again, don't say MAT tax, MAT tax. MAT itself is a tax. Minimum alternate tax we are saying. Okay. So company normal tax has to be computed on total income. MAT has to be computed on book profit. Among these two taxes, which tax the company is required to pay? Whichever is higher. Sir, if MAT is higher, what we need to do? MAT only should be paid. But the excess tax paid over normal tax can be claimed as MAT credit, I am saying. What is that concept? Regarding that concept, I have given you two examples here. You can go through this. Two examples were given for understanding sake. Let us begin. Suppose an Indian company information in the year of incorporation. That means this is the first year. Sir, whenever this is the year of incorporation, what is the tax rate I can say? Right away can I say 25%? Yes, 25% is the tax rate. Suppose X Limited, an Indian company information in the year of incorporation. Ready? Book profit. How much is given? 86 lakh 30. Sir, directly what I have given in that example, book profit is given. That means directly book profit itself we are giving means what is the meaning? Already those 38 adjustments were made and book profit is computed. 86 lakh 30. What is the total income? 48 lakhs. 48 lakhs. Compute the tax payable by the company if the company have not opted section 115 BAB or BAA. Sir, what is that section? Here we have 15% and 22%. That I didn't explain as of now. Here what I am saying is the company has opted or has not opted? Has not opted 15 and 22%. That means normal 30 and 25% only. Okay. So here if you see turnover during this year, how much? 1000 crores. Can I say 30% tax rate? During this year turnover may be whatever may be the turnover, we have to consider based on the next year. Let me explain you that concept. Here if you see the tax rate, how much I have calculated normal tax? 25% only. So did you see the concept? What I have given you the normal tax? 25%. So 48 lakhs into 25%, how much I got here? 12 lakhs. Plus health and education cess at the rate 4%. 48,000. What is the total normal tax I got here? 12 lakh 48,000. Is it clear up to that extent? Sir, surcharge for companies when the income is greater than 1 crore, then we have to levy surcharge. Here income how much I have given? 48 lakhs only. So surcharge I didn't add. So 12 lakh 48,000 is the normal tax. Right side what I have given? MAT. MAT how much, sir? On book profit. How much book profit is given here in this example? 86 lakh 30. 86 lakh 30 into 15%, 12 lakh 94,500 plus health and education is 4%. Total MAT has come to 13 lakh 46,280. Here if you see, what is higher? Normal tax or MAT? You see, normal tax is 12 lakh 48,000, whereas MAT is 13 lakh 46,280. Whichever is higher has to be paid. So normal tax at the rate 25% is taken because there is no turnover during the previous year 17/18. Is it clear, sir? So since MAT is higher over normal tax, what has to be paid finally? MAT must be paid. But sir, many people usually say this 13 lakh 46,280 is to be claimed as MAT credit. That's not correct. The excess tax paid over normal tax, this difference you have to claim it as MAT credit. Right away 13 lakh 46,280 you should not say MAT credit, sir. That excess tax paid. What is the excess tax paid? 13 lakh 46,000 minus 12 lakh 48,000. Around we got here 98,280. This 98,280 what I have to do? This has to be carry forward. For how many assessment years? 15 assessment years we can carry forward. Sir, you are saying to carry forward, that we accept, but what we have to do that carry forwarded amount? Okay, I am carry forwarding this MAT credit. Will I get it refund? No, you will not get it refund. It can be set off against normal tax. When, sir? For that case, I have given you example number 2. For that case, I have given you example number 2. Ready? In continuation of example 1, if company's income for the second year were as follows. Sir, in second year, let us assume what is the book profit? 29 lakh 60,000 and the total income is 16 lakh. Okay. Compute the tax payable by the company if the company have not opted BAB or BAA. That means 15% and 22% is not opted. That means normal rate only. Sir, what is the normal rate I have given to you? 30% or 25%? In this case, what I have to apply? Generally, see. In example 1 and example 2, I have not given in which year. Year of incorporation, okay. But what is this year? 1718 or 1819 or 1920? Nothing is given in this example. Okay. So, what I have given taken here is this 1000 crores. If I assume it is in 1718 year, then what happens? Now the tax rate will become 30%. That in this example, year is not given. Let us take if it is in 1920 year. 1920 year, if turnover is 1000 crores, then in 2021 what will be tax rate? 25% only, because 1718 year they have said how much it has to exceed 400 crores. So in this example 1 and example 2, year is not given. That's why for our understanding sake I have taken 30% here. Generally what can we take in this case? We can take 25%. So in exam they are going to give you in which year the turnover is applicable. So based on that you can solve it. Okay. So now coming to this case, the total income 16 lakhs into 30% I have calculated. That this 30% is not fixed. It depends upon which year turnover. Previous year 1718 turnover we have to take as the basis. Since in this example complete information is not given, I have calculated 30%. Okay. So 16 lakhs into 30% comes to 4,80,000 plus health and education says how much? 4%. So what is the total normal tax I got here? 4,99,200. Now coming into MAT computation, what is the book profit given in the question? 29,60,000. On that 29,60,000, what is the MAT I have levied? 15% plus health and education says. Total MAT has come to 4,61,760. Now see, which is higher? Normal tax is 4,99,200, whereas MAT is 4,61,760. Now tell me, which is higher in this case? Normal tax is higher. So since normal tax is higher, what I have to pay now? Normal tax only. But earlier what I have paid? MAT. That MAT credit is available. Can I set off that MAT credit against normal tax? Yes. Sir, here how much MAT credit I have in this example? 98,280. Can I set off entire 98,280 against this 4,99,200? Let us take that case, sir. 4,99,200 minus, if I take 98,280, what happens? Around 4,01,000 I will get normal tax. Here MAT is 4,61,000. Again we have to pay MAT. Did you understand the concept? That means what I am giving you conclusion is, sir, here again as this 4,99,200, if I set off entire MAT credit of 98,280, then MAT will be higher than normal tax. So that's why what we are saying is how much I have carry forwarded, total or difference? Sir, here how much MAT credit I have carry forward? Did I carry forward 13,46,000? No, difference only I have carry forwarded. In the same way, at the time of set off also, what we have to set off? Difference only. So what is the difference? 4,99,200 and 4,61,760. This difference how much I got? Around 37,440. That 37,440 only we are set off. Is it clear? The balance amount 4,61,760 I have to pay normal tax. So is the MAT credit available last year? Already 1 year has been completed. So it can be carry forwarded for 14 assessment years. 98,280 I think so. Just make a change in the calculation. So 98,280 minus 37,440. So answer is correct, 61,360. So that 61,360 can be carry forwarded for how many assessment years? 14 assessment years I can carry forward. Is this concept clear? So once again I am going to give you, sir, I didn't explain you the concept of MAT. After computing normal tax and MAT, what I have to do? After computing the total income and book profit, what we have to do? That concept we have discussed. Here if you see this theory, however, if MAT is higher than normal tax, then excess of MAT paid over normal tax. What do you mean by the term excess? Difference between MAT minus normal tax. This excess tax paid can be claimed as MAT credit and can be set off. When it can be set off? When normal tax exceeds MAT. Sir, at the time of carry forward, did I carry forward entire MAT or the difference? What I have carry forwarded? Entire MAT did I carry forward or the difference I have carry forwarded? Difference. At the time of set off also, what I have to do? Difference only I have to set off. In order to understand that concept, I have given you this example too. At the time of set off also, the difference only we are making it as a set off. Is the concept clear? So carry forward, difference. At the time of set off also, we have to make difference amount. Is this concept clear? Now let us continue. Sir, for companies, finally, what should I calculate? Normal tax or MAT? Both we have to calculate. After calculating both, what tax has to be paid? Whichever is higher. If MAT is paid, the excess tax paid over normal tax can be claimed as MAT credit for how many years? 15 assessment years. Is it clear? Now coming to the next thing. Sir, I didn't like this concept of MAT. Normal tax I am calculating. Again MAT I am calculating. In MAT you are saying 38 adjustments. As of now we didn't learn that adjustments also. I am not interested in this concept of MAT, sir. Say one tax, that tax I will pay. Is there any such option? Yes. That option is 115 BAB and BAA. Two more options were given for companies. In these two cases, no MAT. Very happy, sir. Rather than calculating those adjustments, in case of MAT, much more discussion is there for us. That adjustments we have to learn. Whether the SSE has calculated that adjustments correctly or not, auditor has to certify in form number 29B, 3CB, 3CD, tax audit report. Like that, MAT audit report we have to give in form number 29B, whether the SSE has computed all those adjustments correctly or not. Rather than making all those calculations, is there any simple option? Yes. Two sections were given. 115 BAB. What is the other section? BAA. Sections don't confuse. First I have given BAB. Right side I have given BAA. Sir, here first tax rate 15% only you are saying. And MAT is also not applicable. Very best option, no sir. Rather than paying that 30% and 25%, it would be better to pay 15%. No. Yes, it is better to pay, but there are some conditions. Condition is very benefit only, no sir. There is no MAT you are saying. Along with that, there are some more conditions to be learnt. There are some more conditions to be learnt in case if the company want to opt that 115 BAA or 115 BAB. So here if you see new tax rates for companies, what is the first part given? BAB, tax at the rate 15%. What is the second part given? BAA. 9th page it was given. BAB and BAA. Ready? So coming to this discussion, first part is tax at the rate, how much is given here? 15%. Second part, tax at the rate 22%. But this 15% will be given to you if you are a manufacturer. A company which is engaged in which activity? Manufacturing activity. Sir, which article they have to manufacture? Your wish. Pens, technological items, stationery items, laptops, whatever may be your wish. Manufacturing is crucial. Manufacture means which changes the nature. Assembling is not a manufacturing activity. So parts we are purchasing spare parts and then we are assembling them. So manufacture definition you have to go through. So which changes the nature will become the manufacturing. Such manufacturing activity is the base here. So companies which were engaged in manufacturing activities, on that manufacturing activity profit 15% tax rate is applicable. That means if company has house property income, if company has other source income, what is the tax rate? 22%. What is 22%? Section 115 BAA. That means BAB is applicable only for which income? Only the income from business. Which business? Manufacturing activity business. Sir, if company does two businesses, normal business and also trading business, you have to maintain a separate books of accounts and compute a separate profit for manufacturing activity. On that manufacturing activity profit, what is the tax rate applicable? 15%. Sir, if company has capital gains, we are not disturbing that one. On capital gains, you have to pay 20% tax only. On short-term capital gain under section 111A, equity shares or equity oriented fund or units of business trust, if I sell and get short-term capital gain, what is the tax rate? 15%. That's lottery income if company gets, how much it should pay? 30%. Special tax rate only. On other incomes, earlier how much company usually pays? 30 or 25%. Rather than paying that 30 or 25%, now we have reduced it to which tax rate? 15 and 22%. But that 15% is applicable only on which income? Only on manufacturing activity income, only 15%. But one thing to be remembered, straight away we are saying 15%, but you have to also pay additionally. Not only health and education says surcharge also. Sir, you said surcharge is applicable for companies if turnover exceeds how much? Sir, not turnover. Total income. Total exceeds how much? 1 crore. But here, even though total income does not exceed 1 crore, mandatory surcharge, how much? 10% and 10% in both the cases. 10% has been specified. Is it clear? So finally, what is the effective tax rate? 15% tax rate, 10% surcharge, 4% cess, 17.16. Here 22% tax rate, 10% surcharge, 4% cess, 25.168%. Generally for new startup companies, what I have said tax rate? 25% only, no? So 25% plus health and education cess. Here also average we are getting 25.168% after adding health and education. Is it clear? So now coming to the thing, how did I get 22% plus 10% means not 32. 22, 10% on 22, that means 2.2. So 22 plus 2.2, 24.2 plus health and education says 4%. Okay, so like that we have to calculate. So finally effective tax rate is been calculated. What is the MAT rate in this case? What I have said to you in 115 BAB and BAA, what is not applicable? MAT is not applicable. That is the benefit which was given here. Okay. If capital gains are there, what we have to do? Long-term capital gain under 112. What is the tax rate? 20%. 112A. Long-term capital gain on sale of equity shares, equity-oriented fund, units of business trust on which STT has been paid. What is the tax rate there? 10% without indexation. Above 1 lakh, if I get 1,50,000 capital gain there, 1 lakh exempted. Balance 50,000 into 10% I have to calculate. Next, short-term capital gain under section 111A, how much? 15%. These tax rates were already given in specifically those sections. Whether that will be altered? No. So their special rates only applicable in both the cases. Special rates only applicable. Okay. Sir, short-term capital gain, what is the tax rate? Generally, what we say for short-term capital gain, normal rate only. Slab rates only we levy. But for company, there is no slab rate, no. So here, on other short-term capital gains, this 22% is applicable. Then in both cases, you have given 22%. Yes, only on manufacturing profit only we have to calculate. 15%. On all other incomes, 22% will only be applicable. Here if you see tax rate on income other than manufacturing. On other than manufacturing income, how much I have to levy? 22% has to be levied. Is it clear? Next, conditions. Here comes very important thing to discuss. The company should be set up on or after 1/10/2019. But here no such conditions. That means a company incorporated during 2003-4. Can it follow 22% tax rate 115 BAA in current year? Yes, it can follow. No such condition. Next, it should start manufacturing activity before 31st March 2023. Sir, you said 2019, incorporation year. After incorporation, it takes time to install the plant and machinery and start production. Before which date production has to be commenced? 31st March 2023, maximum date. Okay. And second-hand plant and machinery, it should not use. It should not use any machinery previously used for other purpose. That means it has to purchase a new plant and machinery. Exception we will see later. Is it clear? Exception we will see later. Exception, okay, let us complete the exception also. If you see, imported plant and machinery permissible, even the second hand imported plant and machinery is permissible. In India, it should not be used earlier. That is the condition. Sir, what I have said to you, it must be a new plant and machinery. In order to claim that 15% tax rate, it must be a new plant and machinery. But imported second hand machinery is also permissible. Sir, local second hand machinery if I purchase, is it permissible? Yes, up to 20% of the total value of machinery. So first what I have said to you, sir, it must be a new plant and machinery. But second hand, to what extent it is permissible? Out of the total value of the machinery, 20% value I can purchase the second hand machinery. Out of India purchase, it can be treated as new only. Out of India import, even though it is second hand, we consider it as a new machinery only. Is it clear? Next, sir, here why I am saying no such conditions? Because here manufacturing activity is not criteria. For 22% tax rate, what is there is no such criteria. It may be trading, service sector, whatever may be. Any company can claim it. Here comes the disadvantage. Everywhere we have advantages and disadvantages, but here disadvantages were more. What is the first disadvantage? No deduction under section 10AA. Sir, what I have said here? No deduction under section 10AA. No deduction under section 10AA means sedge exemption can't be claimed. 10AA is sedge exemption. Generally for sedge units, first 5 years 100% profits exempted. Next 5 years 50% profits exempted. For next 5 years also 50% profit, or a special account will be maintained for purchase of new plant and machinery. Whichever is lower, we can claim exemption. That sedge exemption can be claimed or cannot be claimed? Cannot be claimed. If you opt this 15 and 22%, you can't claim sedge exemption, and additional depreciation is not allowed. What is the additional depreciation? 20% of the actual cost of plant and machinery, I can claim additional depreciation. But the additional depreciation is allowed or not allowed? Not allowed. Sedge exemption not allowed. Additional depreciation not allowed. 32 AD, additional deduction. Of course, now 32 AD, if you see, 15% of actual cost we can claim additional deduction. If you install in notified backward areas of Telangana, Andhra Pradesh, West Bengal and Bihar, 15% additional deduction is given on new plant and machinery. That additional deduction you have to forego. Next, West Bengal, Bihar, there 35% additional deduction is given. That additional deduction you have to forego. Since you are foregoing all those benefits, how much is the tax rate given here? Since you are foregoing all those benefits, how much is the tax rate given here? 15 and 22%. Next, 33 AB, tea, coffee and rubber development account. 40% of the profits I can claim deduction. That you have to forego. 33 ABA, site restoration fund. 20% of the profits I can claim deduction for SSEs who were engaged in extracting mineral oils like petrol, crude oil, who are extracting mineral oils, 20% of the profits we are giving deduction. That deduction can be claimed or should not be claimed? Should not be claimed. Next, section 35. If you remember, scientific research associations, if I donate, rural development programs, if I donate, there I can claim 100% deduction. That deduction you can't claim. 35 2AA 2AB, in-house research and development, there also have given 100% deduction we can claim, but that deduction can be or cannot be? Cannot be claimed, I am saying, sir. Next, 35 AD, specified business, 100% of the new asset cost we can claim it as deduction, but the deduction cannot be claimed, I am saying. Next, 35 CCC CCD, rural development programs and agriculture extension project, there if I donate 100% I am claiming deduction, but now earlier 150%, sir, but from assessment year 21-22 all those higher deductions were restricted to 100% only. Next, 80 IA to RRB, not all ATC deductions. For company there is no ATC at all, LIC for individual and HUF, but for companies no such deductions. For companies only 80 IA to RRB deductions only eligible, but those deductions also should be foregone. Next, this is very important. Last losses can't be set off. Generally, if we have losses, what we usually do? We will carry forward those losses, but the carry forward of losses is also not permissible. Carry forward of losses is also not permissible. Is it clear? Next, no additional depreciation. Next, this is very important. Brought forward MAT credit can't be set off. Sir, here MAT is not applicable now. Then why you are saying brought forward? Sir, existing companies also, can they opt 115 BAA? Yes, 22% they can opt. A company incorporated in 2003-4, can it opt this 22% tax rate? Yes. Sir, there is some MAT credit carry forwarded for that company. It can't be eligible for set off. Any carry forwarded MAT credits for existing companies, can it be carry forwarded? No. 80 JJAA is permissible to encourage employment. Out of the salary paid, 30% of the salaries we can claim deduction. For 3 years we can claim 80 JJAA. That deduction is only permissible. All other 80 deductions were not permissible. If you forego all these deductions, then what is the tax rate? This 15% and 22% can be opted. Once you opt this 15 and 22%, you can't withdraw. Sir, as of now I am following 25%. Okay, normal tax rate only I am there. In 2026-27, can I come for this 115 BAA? Yes. But once you come for 115 BAA, in 2026-27, if you come for 115 BAA, for remaining all the years you have to follow 115 BAA. Existing companies, if you are in normal rate, you go through normal rate. Can I enter into this 115 BAA and BAB? Yes. But once I enter, I can't withdraw. I can't claim these deductions again. If I want set off and carry forward of losses, those are all not permissible now. And you can't withdraw except closing of companies, no option. Again you have to start new company and again you have to opt new tax rate. Here if you see, once these options were opted, it cannot be withdrawn. Sir, is it mandatory for the company to opt this 115 BAA, BAB in the year of incorporation itself? There is no such condition. But if you opt, you cannot opt out. If you opt this 115 BAA and BAB, you can't opt out. That is the meaning. Is it clear? Sir, this 15% is for which companies? Companies engaged in which activity? Manufacturing activity. They only can claim this 15%. Here if you see, some 6 points were given here in note 1. These 6 points were excluded from the definition of manufacturing. That means the SSEs who were engaged in these 6 businesses, they can claim 15% or they can't claim such benefit. They can't claim. That means for these SCs, what is the tax rate? 22% only. So if you see number 1, development of computer software, they are saying we are manufacturing computer software. We don't permit this. This is a service. Mining is a service. Conversion of blocks into slabs. Bottling the gas into cylinders. Printing of books or movies. So all these were generally be called as a service activity only. The people usually say this is a manufacturing, but this is not manufacturing activity. These are to be treated as service activities only. Is it clear? So what we are saying here is business of manufacture does not include these activities. Sir, include or does not include? What I am saying, does not include these activities. That means in these cases 15% rate cannot be opted. However, what can be opted? 22% can be opted. Is this note 1 clear? So by this, which sections we have completed? Now coming back to the basics. Yeah, we are here. For companies, what I have said, normal tax rates, 4 types of normal tax rate: 30, 25, 15 and 22. 30 in which case generally, 25 in which case if turnover during previous year 17-18 does not exceed 400 crores, 15% 115 BAB, 22% 115 BAA. Is it clear? So this part we have completed, sir. Normal tax we have completed. Once again I am giving you clarity. If company opts these 2 sections, MAT applicable or not applicable? Not applicable. MAT is not applicable. Shall we continue? Now what is the thing we need to discuss now? This is important. After computing MAT, how to carry forward the MAT credit, how many years, those are all we have learned. But first of all, now here what we have to learn? How to compute such a MAT. Sir, on total income we levy normal tax. On book profit we levy MAT. So now here comes the question, how to compute book profit? Very simple. We are beginning with which item? Tell me, sir, we are beginning with which item? Net profit as per books. For that net profit as per books, how many adjustments were given there? 38 adjustments were given. So why these adjustments were given? Why this concept of MAT has come into existence? That concept I will explain you. Sir, a company is in the business of cold storage. Any special benefit in income tax for SSEs engaged in cold storage business? Yes. For cold chain activity, a deduction under section 35 AD. What is this deduction? 100% of the assets used for business can be claimed as a deduction. This can be claimed as deduction. 100% of the cost we can claim deduction. That means the cost incurred for constructing that cold storage, including the machinery and equipment used in the cold storage, entire cost can be claimed as deduction. Sir, in the year of commencement of business, let me take an example. Because why this MAT has come into existence, we have to learn now. That's why I am giving you this example. Let us assume the project cost is 100 crores. Let us assume the project cost is 100 crores. Okay. Now, in first year, before claiming 35 AD, the profit is 10 crores. This is before claiming deduction under section 35 AD. Since this is the first year, let us assume there is no 10 crores also, only 3 crores of profit, let us assume. Now what happens? Now tell me whether this company will pay taxes or not. Sir, before 35 AD, how much is the profit? 3 crores. Out of that 3 crores, now I am going to claim which deduction? 35 AD. How much 35 AD deduction? 100% of the asset cost. How much I have invested? 100 crores. That 100 crores I can claim it as deduction. Sir, if we claim 100 crores as deduction, what is the balance? 97 crores. Is it profit or loss? Loss. This is loss from which business? Specified business, not speculative. Loss from specified business. This loss can be carry forwarded for carry forward for no limit. That means any number of years we can carry forward it. But one and only condition here is this loss should be set off against specified business. This 97 crores, if I have another normal business, can I set off against that one? No. This should be set off against specified business incomes only. Sir, in this case, the one and only question I am asking is, how much tax will this company pay in this year? Answer? 0. Why? Company is in loss. How much loss is there here? 97 crores. This loss will be carried forward. How many years? Any number of years. So second year, if there is 5 crores profit, tell me, sir. First year, what is the tax paid? First year tax paid 0. Sir, second year the profit is 5 crores. How much will the tax? How much tax will the company pay? Again 0. Why? I have 97 crores loss. I will set it off. Third year, since the activity has been started, I got 20 crores profit. What is the tax rate? 0. Why? 97 minus 5. 92 crores loss I have. 92 minus 20. What is the balance loss I am carry forwarding? 72 crores. Like that, 4th, 5th, 6th, 7th, around, let us assume 9 years for completed. After 9 years, the carry forward loss is just 1 crore is balance loss left. Now, in 10th year, my profit is 15 crores. Now tell me, what in 10th year we are going to make computation? 10th year 15 crores minus, what is the carry forward loss? 1 crore. Balance profit is 14 crores. This 14 crores, the company is required to pay normal tax. That means, for how many years the company has not paid taxes at all? 9 years, the company has not paid taxes at all. But from 10th year, since entire loss has been set off, now the company is required to pay taxes. The company which has not paid taxes for 9 years, can it get interest to pay taxes in 10th year? It was accustomed not to pay the taxes for 9 years. But now it has become a habit for the company not to pay the taxes. For how many years it has not paid taxes? For 9 years. From 10th year onwards, if we say the company is required to pay the tax, what immediately the thing comes in the mind of managing director? How to reduce the profit. So what they will do? They will build up dummy expenses to reduce the profit. They will try to write more and more depreciation now onwards, because now deduction is completed. Now they will start writing depreciation. Like that, what they will do? They will suppress the income also. Earlier entire income will be recorded. Why? There is no tax. But now since tax is being levied, they will suppress the income. One customer will come and give 5,000 rupees. He will not record in books of account at all. Because if it is recorded, tax has to be paid. So now, what thought will come to the company? How to evade the taxes. Not avoid, evade. Violation of provisions, they will think it of. That's why, keeping all these things into mind, for first 9 years, if we say you claim tax exemption, they will not get interest to pay taxes in 10th year. Because your income tax provisions itself have given benefit to that person that loss can be carried forward for any number of years. That's why this concept of MAT has come into existence. We say the company is not required to pay the taxes till set off of losses. Later when profit comes, the company will not get interest to pay taxes. That's why from first year onwards, which concept has come into existence? MAT has come into existence. Which has come into existence, sir? MAT has come into existence. So what we are going to do in this case here is, so from this year onwards, what we are going to do is, we begin with net profit as per books. We begin with net profit as per books. Okay. After computing the net profit as per books, sir, in books of account, will they claim this 100 crores as deduction? Tell me. In books of accounts, once again I am repeating, this is a company. In books of account, will the company claim 100 crores as deduction? No. In books of account, what they usually claim? Depreciation. So let us assume 10% depreciation. So in first year, how much profit they got? 3 crores. 3 crores minus depreciation, 100 crores into 15%. How much? 100 crores only, know how much they have invested? Okay, 100 crores. So but here for entire year we don't calculate, no. When they have started business we will see. So based on that, date wise we usually calculate. In Income Tax Act we calculate block wise, but here based on number of days of use of asset we usually calculate. Like that, if I calculate, let us assume I got 1 crore depreciation. So balance how much profit I have? 2 crores. This is called as book profit. On this book profit, what we are going to do is, we are going to levy MAT at the rate 15%. Sir, what is the normal tax in first year? 0. But here on book profit, 2 crores into 15%. 2 crores into 15%, around 30 lakhs we get, plus surcharge, plus health and education cess. Those are all we are going to levy in this case. So now normal tax is 0. MAT I got around, let us assume 33 lakhs. Which has to be paid? Normal tax or MAT, whichever is higher. So MAT will be paid by the company. But company, please don't feel. Even though you have paid this 33 lakhs, this 33 lakhs can be carry forwarded as MAT credit. For how many years? 15 assessment years. In which year you got profit? In 10th year. When in 10th year you got profit, out of that normal tax payable, what you can do now? You can set off this MAT credit. Sir, in first year, will the company pay normal tax or not? No. But the company will pay MAT. So from first year onwards, if we say you have liable to pay MAT, now the company will come into a situation, okay, we are paying taxes, but this tax is not a loss. This tax can be carried forward and can be set off in future. So there will be some time value of money. The tax paid in first year is different from tax paid in 9th year. But the time value of money, interest, we have to take it out. The tax paid, it is claimed as credit. Once again I am going to explain. Here now I think to some extent you have understood the concept of MAT. Even though Income Tax Act is giving benefits to companies, using those benefits, the company is not paying taxes at all. In future, whenever the liability to pay tax comes, they are thinking of evasion. That's why from first year onwards, even though normal tax is not levied, if MAT is levied on the companies, now the company is habituated to pay MAT. Later, when the normal tax comes, we will give it as credit. So if initially only if company is habituated not to pay taxes, later when we say to pay the taxes, they will think of evasion. That's why indirect form of levying taxes comes by way of a MAT. So then what is the use of giving 3580 deduction, sir? You are saying normal tax need not be paid, but you are levying MAT, no. Then what is the use of section 3580 deduction? Sir, this MAT is not a permanent tax. This MAT can be carry forwarded and it can be set off in future. We are giving you set off, no. We are not saying that credit will be denied. I am not saying that point, no. It can be used for set off. Is it? There will be time gap. First year taxes were different from 9th year taxes, but the government is giving benefit to carry forward such a MAT credit amount, no. So like that we have to think here. Not only this case, sir, one simple example I have given you here. Additional depreciation. What is the normal depreciation for plant and machinery? 15%. Normal depreciation. What is the additional depreciation we are claiming again? 20%. That means 20 plus 15, 35% I am claiming. But in books of accounts, how much we will write? 10% or 15%, 13.91% in case of Companies Act. That rate only we are going to write. That means when you are claiming higher deductions in Income Tax Act, your tax payable will be 0. One more example I will give you, the best example I will give you. Sir, 80 JJA, the companies who were involved in converting waste into electricity, paper products, fertilizers, biogas, etc. So that means what the company is doing is collection of waste. That waste will be recycled and products were being manufactured. So in 80 JJA deduction, what they have said, 100% of the profits you can claim it as deduction under section 80 JJA. How much deduction I can claim? 100% of the profits. But for how many years? For 5 years I can claim this 80 JJA deduction. How many years? For 5 years. That means 5 years, how much tax payable for the company? What is the tax payable for first 5 years? 0. 100% can be claimed as deduction. From 6th year onwards, what the company should do? Can it claim 80 JJA deduction now? No. From 6th year onwards, it has to pay the taxes. But the company will not get interest to pay the tax. Why? Because for first 5 years, they didn't pay tax. So now what they will do? They will close the company. For first 5 years, they have claimed exemption. No, they have claimed deduction. No. Now they will close the company. And again they will start new company. And again for 5 years, they will claim 80 JJA. Who is going to lose here? Government is going to lose the tax. So that's why, even though for first 5 years, you are not paying normal tax, but the company is required to pay what? MAT on the book profit. On the book profit, you have to pay MAT. That MAT, in order to get carry forward, what you have to do? You have to continue your business from 6th year. From 6th year onwards, when normal tax comes, again as that normal tax, we are going to claim this MAT paid as the credit. Now the company will not get closed. Because in order to set off that MAT credit, it has to continue the business from 6th year. Sir, is the provision clear? Sir, MAT is an indirect form of levying taxes, but that MAT rate will be indirectly given benefit to the SSE only by way of set it off. So now to some extent is it clear, sir, why this MAT concept has come into existence? Because, sir, income tax provisions were given, some provisions were beneficial to SSE. But if we give complete benefit to the SSE from first year onwards, later SSE will not get interest to pay the taxes. That's why, keeping this in point of view, indirectly on companies, what we usually levy, sir? MAT will be levied. But don't think that this is a permanent tax. This MAT paid can be claimed as credit against the normal tax payable later. Is it clear? So just 2 examples I have given. Like the total, how many adjustments were there? 38 adjustments. So let us understand those adjustments in a detailed manner. A small example I have given, 35 AD and JJA. Now let us discuss in a detailed manner. Before that, all of you come to this point. Come to page number 4. If you see here, mode of computing book profit. With what item I am beginning? Net profit as per books. Sir, books of accounts, the company prepares using books of accounts will be prepared by the company using accounting standards or Indian accounting standards, Ind-AS, whatever may be, accounting standard or Ind-AS. Using those accounting principles, you are going to prepare and present the financial statement. That net profit only we are using the basis. Sir, there the donations given by the company were debited to P&L, sir. Okay. Donations, is it allowed under PGBP expense? No, general donations were not allowed. So should I disallow now, sir? Sir, the disallowances in case of computing total income. Now I am not computing total income. Now I am computing book profit. Sir, 15,000 rupees cash expenditure is being paid in a single day to a single person. What we will do? Is that expenditure allowed or disallowed? Disallowed under section 40A(3). After the 15,000 expenditure will be accounted in books of accounts or not? Tell me. Yes, it will be entered in the books of account. It will be claimed as expenditure. Here net profit as per books, here if you see, after claiming that 15,000 rupees only I got this net profit as per books. Whether that 15,000 should I disallow now? Sir, that disallowances is while computing. Disallowances will come while computing total income, sir. But now what I am computing? Book profit. Sir, in book profit total how many adjustments were given? If you see here, 19 plus 19, total how many? 38 adjustments were given. Rather than these 38 adjustments, no new adjustment should be done. Even though you remember all the disallowances, entire subject will come into mind here while computing this math. But all those things you should not consider. Only the 38 adjustments which were given here only should be considered. Sir, is it clear? Sir, TDS has not been deducted. What we usually do? We disallow the expenditure. How much we disallow? On resident payments, if they don't deduct TDS, 30%. On non-resident payments, if they don't deduct TDS, 100% we disallow. But here, that disallowance will not be made. Because I am not computing total income, sir. Here I am computing book profit. So the subject which we have learned as of now is to compute total income. But now the things, these 38 adjustments which we are going to learn now is to compute book profit. So book profit is different from total income. Is it clear? Right. Sir, generally what we usually do while computing total income, if in books of accounts, if they debit any depreciation, what we usually do? Tell me. In books of account, depreciation will be computed as per AS6, okay? Whether we are going to allow that complete depreciation? No. Sir, in total income computation, what we usually do while computing PGBP income? Depreciation debited to books of accounts will be added. What depreciation we are going to reduce, sir? Using which method? Using which method we compute depreciation in Income Tax Act? Block of assets. Using the block of assets concept, we are going to reduce using WDV method. That block of assets depreciation only we are going to reduce. Sir, every adjustment I will explain both from total income point of view and also from book profit point of view. It's a complete new thing we are going to discuss now. Generally, while computing total income, what we usually do? I begin with net profit as per books only. While computing total income, also PGBP income, we begin with net profit as per books. Here what I usually add? Depreciation as per books of accounts I will add. And then what I will reduce? Depreciation under section 32. Block of assets method I will reduce. Then we get a PGBP income. Is this concept clear? But now, while computing book profit, what I have to do, sir? Listen carefully. I have to begin with a net profit as per books. I have to begin with net profit as per books. Okay. Plus depreciation which was debited to P&L. Same. That means as per books of accounts, whatever the depreciation they write, that I will add back. If I reduce block of assets depreciation, it becomes computing total income. Now what I have to reduce, sir? Minus depreciation as per books only. Sir, what is the use, sir? I am adding depreciation as per books of accounts. And I am reducing also depreciation as per books of accounts. Same thing if I reduce, I will get same thing. No. Excluding revaluation. Sir, I didn't get this point, sir. Sir, revaluation means increase in asset value or decrease in asset value? Increase. Decrease means devaluation. But I am saying here revaluation, to increase the value of the asset. Sir, if the asset value increases, is really we are purchasing a new asset or I am appreciating the asset value? Appreciating the asset value. New asset I am not purchasing. Since the market value has increased, I am revaluing the asset. Value has been increased, not a new asset purchase. Sir, if I increase 10 crores asset value, if I increase to 100 crores, what happens? How much is been increased here? Now in books of account, I will write depreciation on which amount, sir? 100 crores. Whenever I am revaluing the asset, on that revalued amount, I am writing depreciation. Sir, now tell me, whether book profit will get reduced or not in this case? Yes, since the assets were, revalued, I repeat, since the assets were revalued, what's happening here? The value of the asset were increasing, so depreciation also increases. Sir, my books, my wish, I am going to increase the asset value and I will claim higher depreciation. While computing total income, what you are doing? Are we allowing depreciation on revalued asset? No, on block of assets only we are allowing. Okay, your books, your wish, you prepare, you revalue, you write high depreciation, we don't bother. But MAT will be computed on which profit? Book profit. In your book profit, what you have done? You have claimed higher depreciation. Sir, my books, my wish, sir, we claim higher depreciation only. We are not saying to disturb your books of accounts. We are not going to prepare your books of accounts now. Your books, your wish. But after computing the net profit as per your books, we are making adjustments, that's it. We are not going to disturb your books of accounts. What we are doing here, sir, come back to our discussion. Depreciation debited to P&L will be, sir, depreciation debited to P&L, what I am doing? I have added, and what I am reducing? Depreciation excluding depreciation on revaluation. That means normal depreciation, simply speaking. Okay, sir, once again please repeat me. While computing total income, what we usually do? Depreciation as per books will be added. Depreciation under section 32 will be reduced. This is while computing total income. But while computing MAT, what we have to do? Depreciation as per books will be added, but what will be reduced? Depreciation as per books only will be reduced, excluding depreciation on revaluation. Okay, one example I will give you so that we can understand. Here if you see in this example, see this adjustments, all of you read this adjustment once. Depreciation debited to P&L, how much is given there? 12 lakhs. Depreciation debited to P&L, how much is given there? 12 lakhs. It includes depreciation on revaluation of asset, how much? 2 lakhs. What we will do in this case while computing book profit, tell me? How much is debited to P&L, sir? 12 lakhs. The 12 lakhs, what I will do? I will add back. Minus, what is the depreciation on revaluation? 2 lakhs. Will I reduce 2 lakhs? Not 2 lakhs. 10 lakhs will be reduced. That means what has been disallowed, sir? Revaluation portion will be disallowed. Because in books of accounts, if you increase the asset value and compute excess depreciation, book profit will be reduced. If book profit reduces, MAT also reduces. Sir, our wish, sir, our books of accounts, you prepare as per your wish, but we make some adjustments to it. Depreciation books will be added back, and what will be reduced? Same only, but excluding revaluation. Sir, in books, if I didn't make any revaluation, in books of accounts, if I didn't make any revaluation, the item which is added will be reduced. That means no need to make adjustment at all. So when depreciation adjustment comes in book profit, straight away question I am asking, when depreciation adjustment comes while computing book profit, whenever there is revaluation of the asset. So in this example, if you see the solution here, how much has been added? 12 has been added and 10 has been reduced. Is it clear? Shall we go back? Like that, total how many adjustments, sir? 38. Out of the 38 adjustments, how many we have learned now? 2 adjustments, one positive and respectively negative. Total here, if you see, sir, around 11 adjustments. If I learn 11, 22 will be learnt, because respective negative adjustments only we will see. So if 11 adjustments were learned, how many were automatically learned? 22 were learned. Is it clear? Now coming back to the discussion, point number 2. Point number 2. What was given there? Deferred tax asset and deferred tax liability. Sir, why the company usually creates deferred tax asset and deferred tax liability? Sir, if we see the benefits given in the Income Tax Act, additional depreciation. How much additional depreciation? 35%. Normal depreciation 15%, additional 20, total 35%. In books of accounts, how much will they write? 10% or 15%, whatever they be, they will write. Here what happens? Profit as per Income Tax Act will be lower, profit as per books will be higher. That means I pay high tax or low tax? Low tax, because I am claiming deductions. No, I will pay low taxes. But now you are paying low taxes, sir. Further year your depreciation in Income Tax Act will be low. Sir, what is the maximum depreciation we can claim, sir? Equal to asset cost. That's it. No. Now in first year only you have claimed 35%, means from next year onwards your depreciation will be low. Income tax depreciation will be low, books depreciation will be high. That means first year your profit may be lower, but from further years onwards your book profit will be higher, your income tax profit will be higher, book profit will be lower. One more example I will say, sir. Bonus is not paid to employee. When bonus is not paid, tell me, section 43B, whether we allow the bonus as expenditure or we will disallow. What we usually do? When bonus is not paid, allowed or disallowed? Disallowed. Under which section? 43B. So is it a permanent difference? No, this is just a timing difference. Next year if they pay the bonus, the disallowed expenditure will be allowed. That means first year we are making disallowance and increasing the income tax profit. Sir, this is income tax profit, this is books profit. Okay. If you make disallowance, what happens? Income tax profit will be increased. And we are paying higher taxes. But don't worry. Next year, if the bonus amount is paid, now tell me. Now in income tax, we are going to reduce this. But in books of account, will I again write the expenditure? No. So in next year, your income tax profit will be lower. You will pay lower taxes. That means in first year, due to disallowances, you might have paid higher taxes. But in further years, you will pay lower taxes. So this is called as timing difference. For the timing difference, sir, first year I have paid higher tax, but further years my tax will be reduced. No, if you pay higher taxes, it's your asset. So what we usually create here, deferred tax asset we will create. What we usually create here, deferred tax asset. AS 22 will give a detailed discussion how to compute that deferred tax asset and deferred tax liability. Sir, simply speaking, please listen carefully. Due to timing differences, what do you mean by the term timing difference? In Income Tax Act, some expenditure might be claimed higher in this year, but further years it will be reduced. There might be disallowance in current year, but in further years it may be reduced. Just a timing difference. In some years you might have paid higher taxes, but in further years it will be reduced. This is called as a timing difference. For the timing differences, sir, here we have a concept of accrual. That means whenever we earn income, the expenditure also should be written off in the same year. So current year if there is disallowance, next year if there is allowance, there will be timing differences. For the timing differences also, provision will be created as per which standard? AS 22. Deferred tax asset and deferred tax liability. So deferred tax asset will be credited to P&L. Deferred tax liability will be debited to P&L. In books of accounts, they will debit deferred tax liability and they will credit deferred tax asset. What we have to do, sir? The deferred tax asset and deferred tax liability. Is it a real expenditure? No, it is just a provision. So that's why we are going to reverse those adjustments. Sir, once again I am repeating. Deferred tax asset will be credited or debited to P&L. It will be credited. That means profit is increased. So that's why here we are going to reduce the negative adjustments. I have given deferred tax asset. Deferred tax liability will be debited to P&L. The deferred tax liability has been added in positive adjustments I have given. Sir, is the concept clear? So simply speaking, deferred tax asset, answer, minus deferred tax liability, answer, add. Sir, while computing total income, what we will do this deferred tax asset and liability? Tell me. Everything not only from book profit point of view. We have to learn total income point of view also. Tell me. While computing total income, what we usually do? Deferred tax asset and liabilities. Tell me, sir. While computing total income, whether taxes can be claimed as expenditure? No. Income tax disallowed. Dividend distribution tax disallowed. Of course, now from 21-22, 2021 year onwards, no dividend distribution tax. Interest on income tax disallowed. Advance tax disallowed. Wealth tax disallowed. GST allowed. Not all the taxes will be disallowed. Income tax will be disallowed. Then deferred tax asset and liability also on income tax only, no. That means this adjustment is same. What same? Same while computing total income and also book profit. Sir, while computing total income also, deferred tax asset will be reduced and deferred tax liability will be added. In the same way, while computing book profit also, the same thing we are repeating here. Sir, is the provision clear? So deferred tax asset, answer, reduce. Deferred tax liability, add. Once again repeat the adjustment. Sir, we are computing which profit? Book profit. While computing book profit, we have to begin with, repeat, we have to begin with net profit as per books. What is the first adjustment? Depreciation debited to books will be added. What we are going to reduce? Depreciation excluding revaluation. Number 2, deferred tax asset less deferred tax liability, add. Shall I continue? Next. Sir, if company has agricultural income, let us assume this is the P&L account of a company. Okay. Here, if company has agricultural income, that will also be created to P&L account only, no? Okay. Company has agricultural income of 10 lakhs. Finally, to net profit 28 lakhs. Okay. Sir, while computing total income, what we usually do? We begin with net profit as per books. How much? 28 lakhs. Out of this 28 lakhs, tell me, sir, this 28 lakhs is after including which income? Agriculture income also. Is agriculture income taxable or exempted? Exempted. So exempt income under section 10 subsection 1, that agriculture income 10 lakhs will be reduced. Balance 18 lakhs only will be considered as the business income. This is while computing what? Total income. While computing total income, exempt incomes were exempted. No, that's why the exempt incomes will be reduced. Now, while computing what? Book profit. I repeat, now while computing book profit, we begin with net profit as per books. What is the net profit as per books? 28 lakhs. On book profit, what we are going to levy, sir? MAT. If I levy 28 lakhs into MAT 15%, what is the use of giving exemption for agriculture income? While computing total income, tell me, sir, exempt incomes will be reduced. In the same way, while computing book profit also, sir, whether exempt incomes will be credited to P&L or not. Since the income is exempted, will the company does not make entry in books of account at all? Will the company write in books of accounts or not? Yes. Exempt incomes also entry will be made in the books of account. That exempt incomes, while computing total income, we are giving exemption. Exempt incomes are always exempt. Please remember this sentence, a simple sentence. Exempt incomes are always exempt means not only while computing total income, while computing book profit also. Now tell me, what is the conclusion? While computing book profit, what I have to reduce? What I have to reduce, sir? Exempt income. I am speaking minus negative adjustment. I am saying while computing, I repeat, while computing book profit, the exempt incomes must be excluded because exempt incomes are always exempt. Exempted not only from normal tax, exempted also from MAT also. Am I clear? So finally speaking, come back to the theory. Exempt incomes have to be reduced, sir. First I am speaking negative adjustments. Exempt incomes have to be reduced because here with which item I am beginning, sir? Net profit as per books. This includes exempt incomes also. That's why net profit as per books, when I begin, exempt incomes have to be reduced. When any expenses relating to exempt incomes were debited to P&L, since income is exempted means expenses were also exempted. That's why that expenses must be added. Since income is exempted, sir, expenses can't be claimed as deduction. That's why expenses were being added back. Sir, is it clear? Once again, what is the third item? Exempt incomes must be sir, positive or negative? Tell me, sir. Exempt incomes must be reduced. Expenses relating to exempt incomes must be added back. Exempt incomes means all exemptions under section 10. Is it clear? So, but in bracket one item has been given except 10AA. Sir, what is section 10AA? SEDGE exemption. For units which were located in SEDGE. Sir, for SEDGE units, what is the benefit? Please see here. For first 5 years, 100% of the profits can be claimed as exemption under 10AA. For next 5 years, 50% of the profits were exempted under 10AA. First 5 years fully exempted. Next 5 years 50% exempt. Next 5 years also 50% or a new reserve has to be started, which I will explain in exempt income chapter. Okay. So reserve amount transfer to reserve, whichever is lower can be claimed as exemption. That means indirectly how many years the SEDGE unit is claiming exemption? How many years? 15 years. For 15 years, if we don't levy taxes at all, from 16th year, if we say to pay the taxes, they will not get interest to pay. That's why, even though this SEDGE income first 5 years it is fully exempted, sir, all exempt incomes were exempted while computing book profit, but except 10AA. That means, now tell me, while computing book profit, whether 10AA exemption can be claimed or cannot be claimed? Cannot be claimed. That means, now in one sentence I have to get the answer. For the units located in SEDGE, normal tax is not levied, but MAT is levied. Write that sentence, sir. Sir, here there is except, I have said no. Regarding that exception I am saying, that is for units located in SEDGE. Please make a note, all of you. For units located in SEDGE, comma, Normal tax is not levied for units located in SEZ. Normal tax is not levied. But for units located in SEZ, normal tax is not levied. But what will be levied? MAT will be levied. But MAT will be levied. Sir, you said exempt incomes are always exempt. No, sir. But there is an exception. What is exception? 10A. Except 10A. Is the third point clear? Sir, here 3 adjustments we have learned means 3 into 2. 6 were learned. Okay. Sir, while computing total income, what we will do the third point? While computing total income, the third point, what we usually do? We will give such exemption. But here, while computing book profit, we don't give such exemption. Okay. So now let us not forget the adjustments which we have learned, sir. Because all these 38 adjustments only we have to do. Remaining we should not do. Tell me, what is the first item? Depreciation. What we are computing? Book profit. MAT is 15% of book profit. Okay. While we are not computing MAT, first we are computing book profit. On that book profit we levy 15% MAT. Okay. Now tell me. Number 1, depreciation debited to P&L will be added. The depreciation excluding revaluation will be reduced. Deferred tax liability add, deferred tax asset less. Number 3, exempt incomes will be reduced. Expenses relating to exempt incomes will be added except 10A. Okay. Next point number 4. Sir, in books of account, if company writes transfer to general reserve, can the company make transfers? Yes. Out of the profits to general reserve or special reserve, if amount is transferred to reserves, what happens? Book profit will be, I repeat, if amounts were transferred to reserves, book profit will be reduced. If book profit reduces, MAT also reduces. Sir, our books, our wish, sir, we will transfer to reserve. What you will do? We are not disturbing your books of accounts. What we are going to do? That amount which is transferred to reserves will be added back. Did you see here, sir? Amount transferred to reserves. First adjustment. Because if amounts were transferred to reserves, profit will be reduced. When profit reduces, tax also reduces. That's why the amount transferred to reserves will be added back and the amount withdrawn from reserves will be reduced. Why, sir? Since transfer is not permitted, at the time of withdrawal, the transfers to reserves means debited to P&L or credited to P&L? Transfers to reserves, debited to P&L. Since it is debited, we are adding back. Withdrawn from reserves will be credited to P&L. We debit only, we didn't give permission. How we will tax the credit? That's why amount withdrawn from reserves will be reduced. Is it clear, sir? Once again I repeat, amount transferred to reserves will be added back. Amount withdrawn from reserves will be reduced. Is adjustment number 4 clear? Amount transferred to reserves will be added. Amount withdrawn from reserves will be reduced. Sir, while computing total income, what we will do, sir? This fourth item. This fourth item, amount transferred to reserves while computing total income. Whether Income Tax Act permits transfer to reserves? No. Even while computing total income also, what we will do? We'll add back the reserve. But for banks and finance institutions, if you remember, there is concept of special reserve in section 36, where 20% of the profits or amount transferred to reserves or maximum twice the paid up capital. Among these three, whichever is lower can be claimed as deduction under section 36. But whether that deduction will be given in while computing book profit? No. Only the adjustments which were given here only we have to learn. Sir, is it clear? So, what is the fourth item, sir? Amount transferred to reserves will be amount transferred to reserves will be added back. Amount withdrawn from reserves will be reduced. Next, here if you see, there were 4 items relating to the concept of business trust. which we will discuss later. After business trust chapter discussion, I will link this 4 provisions. You see, I will show you for our remembrance sake. Business trust chapter number 21. Here if you see this business trust, sir, yeah, here I have given MAT adjustments. How many adjustments I have said here? 4. 4 positive, 4 negative. Total 8 adjustments relating to the chapter called business trust. So there I will link these provisions, sir. Keep it pending. So total 8 were completed. Now coming to 9th item. Sir, what is the tax rate for partnership firms? I repeat, what is the tax rate for partnership firm? 30% tax rate. What is the tax rate for AOP, association of persons? Partnership firm means a deed in writing. If it is there, we assess it as a partnership firm. If such deed is not in existence, we assess it as an AOP. As an association of person, we are going to make assessment. What is the main difference? Partnership firm 30% tax rate. Association of person, what is the tax rate? Slab rate. But when all the members' income is below basic exemption limit, all the members who were in AOP, all those members' income should be below basic exemption limit. Then only AOP is tax rate slab rate. Up to 2,50,000 exempted, 2,50,000 to 5 lakhs 5%. Like that we are levying tax rate for AOP when all the members have income below basic exemption. All the members should have. But if any member has income above basic exemption, AOP will be taxed at MMR. MMR stands for maximum marginal rate. What is the maximum tax rate, sir? 30%. What is the maximum tax rate? 30%. Plus surcharge plus health and education. This is called as MMR. Regarding MMR, there is a separate discussion in association of persons. MMR stands for maximum marginal rate. Okay. Once again I am repeating. If a company is a member in AOP, sir, AOP, what I have said, if all the members' income is below basic exemption, slab rate. If any person income is above exemption, MMR, maximum marginal rate will be 30% plus surcharge plus health and education cess will be levied. Now my question is, what is the question given there? When AOP is a member of a company, sorry, if a company is a member of AOP, now tell me, what is the basic exemption limit for companies? No basic exemption. That means if company is a member of AOP, what is the tax rate applicable for AOP? MMR. That means how much tax will that AOP pay, sir? 30% tax plus surcharge plus health and education cess. Since that high tax is paid by AOP, sir, whatever profit AOP will get, it will share to whom? Members. Who is the member of AOP? Company. Now the company is receiving share from AOP. AOP has paid higher tax. Again, why should we pay MAT? Sir, is it clear? Now what I am going to explain to you is, sir, please see here. If in company P&L account, by share of income from AOP, if they get 5 lakhs rupees of share, on this 5 lakh rupees, AOP has paid. What it has paid, sir? MMR. High rate it has paid. That share only we are receiving. Again on this share, if we levy 15% tax as MAT, it becomes burden, no? So that's why this share of income is exempted by way of relief under section 86. Not only while computing normal income, while computing MAT also, I repeat, while computing MAT also, this has to be reduced. Sir, is it clear? Sir, why we are giving this? Simply speaking, share of income received by company from AOP is taxable or exempted? Exempt. But under which section? 86. This is called relief under section 86. Sir, tell me, this relief under section 86 is against normal tax or MAT? Both. Is it clear? So share of income will be reduced. Loss, if any, debited will be added. Share of income will be reduced and loss, if any, debited will be added. Sir, why this adjustment has come? Because already the company, already AOP has paid MMR. Sir, what happens if it is a partnership firm? Tell me. If can a company become member in a partnership firm? Yes. By share of profit from a partnership firm. If 5 lakhs is received, tell me what happens? Company partnership firm has already paid 30% taxes. No. Share of income from partnership firm is exempted under section 10 subsection 2A. All the exempt income should be reduced. We have already learned that point. Sir, all the exempt incomes will be reduced while computing MAT. But this AOP income is not exempt. It can be claimed as relief under section 86. That's why specifically we are saying you exclude that one also. Once again I am repeating, sir. Share of profit from partnership firm is exempted. Share of income from AOP can be claimed as relief under section 86. Is it clear? But when this relief will be given, since AOP has paid MMR? Sir, why specific point is not given for partnership firm, sir? Share of income from partnership firm should be reduced. Why I didn't give that point specifically? Because I have already said to you that all the exempt incomes must be reduced. So all exempt section 10 exemptions will be covered there. That's why a specific item is not covered here. Is it clear? Next. Coming to point number 10. Please listen carefully. Sir, generally there is a section called 115A which we will learn in non-resident taxation. What it has been specified there is, if a foreign company receives royalty and fees for technical service, under section 115A, tax rate applicable there is only 10%. Sir, this 10% is normal rate only. To encourage the royalty and technical service income from foreign companies, what they have said that if income is accrued to foreign companies from number A, capital gains, B, interest, royalty, technical fees, whatever may be. Sir, section 115A, sir, many tax rate were being specified, which we learned in non-resident taxation. Some incomes 5% they have said, some incomes 10% they have said. Why this lower rate, sir? To encourage inflow of foreign currency into India, lower taxes were specified for non-resident. Is it clear? Sir, foreign company is a non-resident. If they receive these incomes, some exemptions, lower tax rate were being given. Okay. But here, what is the MAT rate we are saying? Sir, once again I am repeating, MAT is applicable for whom? Companies. Which company? Private, public, domestic, foreign company also. MAT is applicable to all the companies. Sir, when foreign company profits will be liable to tax in India? If you remember residential status basics, sir, if it has establishment in India, if it has any branch in India, that branch profits we have to levy normal tax. Not only normal tax, we should also calculate MAT also. While computing MAT, if in section 115A they said only 10% taxes, here how much is the MAT said? 15%. Which is higher? 15. Second year or third year, fourth year, whatever may be, 15% is only higher. If you levy normal tax itself is 10%, sir. How we can levy MAT at the rate 15%? Is it clear? That's why these types of incomes, where, so please see what is the term which I am focusing here. Please see what I have put in box. What I have put in box? Where income tax payable is less than 15%. Those incomes must be reduced directly, because on them normal rate itself is what, sir? 10%. Sir, can I say MAT also 10%? No, we can't levy MAT on those items. Their normal tax only should be levied. That's why what we are doing? We are reducing. Once again I repeat, sir, which company point of view I am speaking this one? Foreign company. What foreign company is receiving? Any income. Under which section? 115A. If their tax rate is below, tax rate is below 15%. Now on that item, what we should not levy, sir? MAT should not be levied. That's why the income received will be reduced. Loss or expenditure, if any, debited will be added. The 10th positive point also, did you see? Income is reduced, that is reduction. Expenditure added is 10th positive point. One item if we learn, another item also not automatically we are learning, sir. Next, there is another section called section 115 BBF. This is applicable for patent developed and registered in India. Sir, patent means manufacturing process. If for manufacturing process, if I don't take patent, what happens? Duplicates will come into existence. Duplicate products for lower price they will sell. That's why if I introduce any new manufacturing process, what I will take immediately? Patent I will take. Okay. Regarding that patent, where that patent is developed, sir, if you see there, the patent developed and registered in India. Sir, who has reputation now? Which country got reputation now? India. Because a new manufacturing process is registered in India. Sir, what is the use of this patent? My patent, that means my manufacturing process, can it be copied by others? No. That's why I am registering my patent. Sir, can I give it to others? If they use without my permission, I can lodge a case against them. But can I give permission to them to use my manufacturing process? Yes. But will I freely give? No. What I will collect here? Royalty. If I give patent to others and I collect royalty, on that royalty, special tax rate 10% is specified in which section? 115 BBF. But you should not claim any deduction. Even expenses also you should not claim. Without claiming expenses, they said 115 BBF. What is the tax rate on royalty? 10%. If you opt that section, sir, for royalty, if you remember, there is 80 RRB patent. 3 lakhs deduction you can claim out of royalty income. But those deductions were not permissible. Straight away, how much tax rate is given? 10%. Sir, royalty received 10 lakhs, sir. Okay. Expenditure incurred 2 lakhs for earning this royalty. That cannot be reduced. Straight away, 10 lakhs into how much? 10% should be paid. Sir, I am not explaining MAT adjustment. What I have explained as of now is section 115 BBF I have explained. Finally, any royalty income earned in India by giving patent registered where? In India to others. Which income I am going to get here? Royalty. On that royalty income, what is the tax rate? 10%. Is this 10% mandatory or option? Option. Sir, I got 10 lakhs royalty, sir. For that earning 10 lakhs of royalty, 6 lakhs expenditure I have incurred. Can I reduce that 6 lakhs expenditure? Yes. On balance 4 lakhs, if you want 80 RRB deduction, that also you can claim. 3 lakhs. On balance 1 lakh, normal tax has to be paid. Or if you don't want any of these deductions, simply you pay 10% tax on 10 lakhs received. Sir, is it clear? This 115 BBF is mandatory or option? Option. Sir, once again I am saying I didn't go to MAT concept. First, what I have explained you, section 115 BBF I have explained you. Now can I continue? Now, if a company is the owner of that patent, what that company is doing? It is assigning that patent to others. Now the company will receive royalty. On that royalty income, if company opts 115 BBF, what is the tax rate paid by the company? 10% only. Okay. This royalty will be credited to P&L or not? Yes. That means in net profit as per books, it includes which income? Royalty income also. On that royalty income, normal tax itself is 10%. How can we levy MAT at the rate 15%? Is it clear? Like that, if company has royalty income and if company opted which section? 115 BBF, such royalty income must be, repeat, that royalty income must be added or reduced? Reduced. Expenditure relating to royalty income must be added back. Sir, is the 11th point clear? Income must be reduced. Expenditure relating to royalty income must be added back. Okay. Sir, all of you, is it clear? Point number 11. Point number 11, why it has come into existence? Very simple. Normal tax itself is 10th and 11th point. What is the common point you have observed there? Tell me, sir, in 10 and 11, did you observe any common point? Yes, their normal rate itself is below 15. How can we levy MAT at the rate 15? That's why, will we restrict MAT to 10%? No, MAT is not levied at all on those items. Those were added or reduced? Reduced. Those expenses will be added back. Okay, sir, here except 6, 7, 8, 9, remaining all were learnt or not? Yes. Now coming back to our discussion, here we are beginning with net profit as per books. Depreciation debited to P&L, add, excluding revaluation we have to reduce. Sir, in exam they don't say this is MAT adjustment. We have to remember. How can we remember? By repetition. That's why I am repeating the points again and again. Number 2, deferred tax liability, add, deferred tax asset, less. Amount debited to reserves, debited to P&L by way of reserves, that means amount transferred to reserves, add. Amount withdrawn from reserves, reduce. Exempt incomes, reduce. Expenses relating to exempt incomes, add that. 5, 6, 7, 8, keep it pending. After business trust we will discuss. Next, number 9, share of income from AOP, reduce. Share of loss from AOP, add back. Why we are doing this adjustment? Because already AOP has paid MMR. Next, income received by foreign companies and royalty received by any company. Royalty, the point number 10 focuses on foreign company only, because 115A is applicable for foreign companies, whereas 11th point, any company receiving royalty income. Here tax rates itself is below 15%. That's why these incomes were reduced. Expenses relating those incomes were added. Up to this point, is it clear, sir? Now let us continue our discussion with up to this 11 points, sir. What we have done is common we have learned, both negative and also positive adjustment in common we have learned. But now coming to point number 12. Ready? Tonnage tax, here separately we have to learn, sir. Positive adjustments and negative adjustments separate we have to learn. First come for positive adjustments. Point number 12. Provision for unascertained liabilities and provision for losses of subsidiary companies. So first of all, let us discuss this losses of subsidiary companies. Subsidiary company from holding company books of accounts, subsidiary company investment will be in balance sheet, asset side. Investment in subsidiary they will write. This is a permanent investment. If subsidiary company incurs loss and the provision for that loss is created by whom? Holding company. Sir, is the subsidiary company shares were sold by the holding company? No, shares were not sold. But since subsidiary company is having losses, investment value will reduce, no? For that reduction, it is creating a provision as per AS 23 or AS 21, consolidated financial statement. Sir, who is incurring losses here? Subsidiary company. For that losses, who is creating provision? Holding company. Why that is creating, sir? Because it has investment in subsidiary. No, if subsidiary is having losses, automatically the value of investment will get reduced. That's why in standalone statements, not consolidated financial statement, in standalone statement of holding company, will it create provision for losses of subsidiaries? Yes. Sir, is it a real loss? No, when the shares were sold, then it will get lost. That's why any provision created, this is not a real thing. Any provision for losses of subsidiaries were being added. Is it clear? Next, provision for unascertained liabilities. Sir, what is the term used here? Sir, one thing. If I delete this term, sir, you don't strike it off. Just for understanding sake, I am saying. You don't strike it off. If I delete this term, now you read provision for liability, provision for gratuity liability. Okay, like that, any provision you create, provision for bad and doubtful debt, it's a provision. Provision for liabilities, I didn't say to add back. What was given here? Provision for unascertained liabilities. Sir, provision for gratuity, if I say, specifically I am saying it's a provision for gratuity. Ascertained or unascertained? Ascertained. That you need not add back. Provision for unascertained liabilities only you need to add back. Sir, while computing business income, now tell me, provision for gratuity, allowed or disallowed? If you remember, gratuity, provision for gratuity, section 36. Only gratuity paid will be claimed as deduction. Provision for gratuity, what we will do? Add back. But while computing book profit, provision for gratuity need not be added back, because this is a ascertained liability. Only unascertained liability. Sir, unless given in question, we don't know whether it is ascertained or unascertained. In question, if it is specifically given that provision for unascertained liability, that will be added back. Is it clear? Now point number 13, income tax, dividend distribution tax, interest, surcharge, health and education cess. Sir, all these taxes, while computing business income, what we have done? Disallowed. Section 40 we have disallowed, no? Same while computing book profit also. Sir, company income tax will be debited to P&L. There is no option to company. All the expenses will be debited. Those we are going to add back. Income tax, dividend distribution tax, interest, surcharge, everything were being added here. Is point number 13 clear? Tax on distributed profits under section 115 are buyback. Now on buyback of shares, who has to pay the taxes? Company only should pay. Like that, those taxes should be added back. But wealth tax need not be added. While computing income normal tax, what we are doing? Income tax, wealth tax also disallowed under section 40. But while computing book profit, wealth tax need not be added. Of course, now there is no concept of wealth tax at all. Practically, no concept of wealth tax. But theoretically speaking, wealth tax will be disallowed while computing total income. It will not be disallowed while computing book profit. In exam, they will not give, sir, because now there is no wealth tax at all. Any arrears, if it is paid, then we have to see this concept. Okay, very, very important. 14th item. What is that one? Proposed dividend or dividend paid. Tell me, sir, is dividend expenditure to the company? Company and shareholders point of view, entity concept will come. That means company is different, shareholders were different. Even the investment is made by shareholders. If any one shareholder dies, automatically will the company close? No. Perpetual succession we usually say. Members may come, members may go, but company goes on forever. In the same way here also, company is different, shareholders were different. That's why any dividend paid to shareholders or dividend proposed to shareholders, it will be debited to the P&L account. Proposed dividend or dividend paid will be debited to P&L account. But from income tax point of view, if you see, this is just an appropriation of profit only, no? Dividend is nothing but appropriation of profit only. That's why dividend can't be claimed as deduction. Dividend is nothing but profits. Sir, profits only were distributed as dividend. How can we give dividend as deduction? Sir, what is the conclusion I am going to give you? Dividend is an allowable expenditure or not allowed? Not allowed. Total income, while computing total income also, dividend will be disallowed. While computing MAT also, dividend will be disallowed. Proposed dividend or dividend paid will be disallowed. Is it clear? Interim dividend. year-end dividend, whatever the name you say, all types of dividends it is allowed. Shall I continue? Next point number 15. Provision for diminution in the value of any asset. Simply speaking, AS 28. Impairment of assets. Tell me. AS 28, do you remember? Impairment of assets. Impairment of assets. Now tell me, what is the conclusion I am going to give you? As per AS 28, impairment of assets. What we usually do? For assets, we create depreciation, sir. But still after writing depreciation, WDV is 40 lakhs. But its market value is only 23 lakhs. What we will do? That 17 lakhs difference we create a provision, impairment loss. Even though we are writing depreciation, but in balance sheet the value of the asset and market value are different from each other, then we reduce the asset value by creating a provision. But that provisions were not permissible under Income Tax Act. The provisions which were debited will be added back. If you see there, provision for diminution in the value of any asset will be added back. Continue. Provision for diminution in the value of any asset will be added back. I will give you one example. You say whether it is to be added back or not. PBD. PBD stands for provision for bad and doubtful debts. Tell me, if provision for bad and doubtful debts were debited to P&L, whether, sir, while computing total income, whether provision for bad and doubtful debts allowed or disallowed? Disallowed. Only actual bad debts were allowed. Provision for bad and doubtful debts only for banks and finance institutions, if you remember, 5% or 8.5% of gross total income. Those concepts I have explained in section 36. Okay, but for all others, provision for bad and doubtful debts will be disallowed. While computing book profit also, now tell me, while computing book profit, tell me whether provision for bad and doubtful debts can be allowed or disallowed. Tell me, bad debts, on which item we create this provision? On debtors. Debtors is nothing but our asset only, no? For that asset provision we are creating. Any provision created for assets will be added back while computing book profit. If you see item number 15, what is item number 15? Provision for the diminution in the value of the asset will be added. So now what is the conclusion? Provision for diminution in the value of asset will be added. Simply reducing the asset value is not correct. If you reduce your, really if you sell the asset, then you get a loss. Those items we are not going to add back now. Is it clear, sir? Provision for diminution the value of any asset will be added back. Continue. Next, point number 16. Amount standing in revaluation reserve if not credited to P&L account on disposal. Sir, here what is the item we are focusing is disposal of asset. Disposal means nothing but selling. Disposal means I have sold the asset. Upon selling the asset, what's happening here? Now the asset is there or not in existence? Now the asset is not in existence. So amount which was standing in revaluation reserve. Now what is the use of that reserve? Sir, revaluation reserve, how it will be created? Asset value increases, revaluation reserve also increases. Okay. Now the asset has been sold means when there is no asset, what is the use of reserve? Now what that reserve has to be do? It should be taken to P&L account as income. If company takes it as income in net profit as per books, that revaluation reserve income also will be. We don't bother regarding that item. But here if you see, if the company does not credit to the P&L account, that means directly if revaluation reserve is transferred to general reserve, we are not taxing that profit, no sir. If asset is not sold, it's okay. But here what happened is on disposal. That means asset has been, tell me sir, asset has been sold. That means revaluation reserve is realized or not realized? Sir, asset has been sold, sir. That means entire asset value we have received means that asset value only now you have increased and created reserve. That reserve is also realized now. Since it is realized, you have to take it to P&L account. But if you don't take to P&L and directly transfer to general reserve, here book profit MAT is missing, no? That's why what we are doing. Amount standing in where, sir? I repeat, amount standing in where? Revaluation reserve. If it is not created to P&L account on disposal, I am going to add it back. Sir, if it is created to P&L, no need to make adjustment. If it is already created to P&L, no adjustment at all. Is 16th point clear, sir? Next. 17, 18, 19 is for companies which follow Ind AS. These three are for companies which follow Ind AS. Which Ind AS adjustments I will discuss later, sir. Keep these three pending. Normal adjustments I will discuss in today's session. Next session I will discuss this Ind AS, those business trust adjustments, which we will discuss later. Okay, now continue. If you see, all the positive adjustments were completed. Now coming to negative adjustments. Point number 12. Profits of which company? Tonnage tax companies. Tonnage tax companies means for companies which is in shipping business. That means transportation through ships. A separate provisions were given in section 115 for tonnage tax companies based on their tonnage capacity. Based on their tonnage capacity. For tonnage tax companies, here if you see tonnage tax companies, tonnage income up to 1070 for each tons, 1000 to 10,000, like that some slabs and tonnage income has been given. So for companies which are in shipping business, a separate presumptive income has been specified. So for them, what is not applicable? MAT is not applicable. That's why profits of tonnage tax companies were reduced. Sir, every adjustment logic also I am explaining why I am reducing, why I am increasing. That logic is been explained to remember in an easy manner. Okay. Next point number 13. Profit from which company? SICK Industrial Company, where Board of Industries has already declared it as a SICK. SICK means its losses have exceeded the capital also. That company, if it gets profits, immediately if we levy MAT, it is going to become more SICK. That's why profits of which companies? SICK Industrial Undertakings will be reduced. Next, very, very important adjustments I am discussing now. Very, very important adjustment I am discussing now. Point number 14. Brought forward loss or loss on account of depreciation, whichever is lower. So generally we separate unabsorbed depreciation and business loss. Why usually separate business loss and unabsorbed depreciation? Unabsorbed depreciation can be carried forward for any number of years, no time limit. It can be set off against any head of income. and even though return is filed belatedly also, unabsorbed depreciation we can carry forward. But for business loss, it should be set off within 8 years. It should be set off against business incomes. Only within due date, if we file return of income, then only business loss can be carried forward. Like this, there are conditions for business income. So we have bifurcated unabsorbed depreciation business loss. Sir, whether both can be set off against business income? Yes. But first preference we give to business loss and then to unabsorbed depreciation, because for unabsorbed depreciation there is no time limit. But here, while computing book profit, if there are carry forward losses, can I reduce? Yes, but whichever is lower only. Once again I repeat, sir, while computing a total income, while computing what, sir? Total income, I reduce both unabsorbed depreciation and also business loss. But here, brought forward loss or depreciation, whichever is lower as per books of accounts only. Not income tax carry forward losses. In your books of accounts, what is your carry forward losses? You have to see that loss is only eligible for set off. Whether total business loss I can set off and total depreciation? No, whichever is. Tell me, sir, whichever is higher or lower? Lower. That means either business loss or depreciation. Sir, see this example. Brought forward business loss and depreciation. Assessment year 15-16, 3 crores, 1 crore, 16-17, 5 crore, 2 crores. While computing MAT, which I have to reduce? Business loss or unabsorbed depreciation, whichever is lower. What is the total? Total you have to check, sir, not each year. What is the total business loss? 3 plus 5, 8 crores. What is the total depreciation? 3. So 8 or 3, whichever is lower. 3 crores only eligible for set off. Sir, while computing total income, all items I can reduce. But while computing book profit, whichever is lower only should be reduced. Is that 14th item clear? Brought forward loss or depreciation as per books, whichever is lower. Shall I continue? Next. Point number 15. But in note 1, I have given some companies which can set off both business loss and also unabsorbed depreciation. But for whom? Come to note 1. Companies under insolvency, simply speaking. Simply speaking, companies under insolvency can claim both business loss and also unabsorbed depreciation. Shall we continue? 15th was completed. Next, 16th point. Withdrawal from revaluation reserve to the extent it does not exceed the amount of depreciation on account of revaluation. Very simple point. Sir, in P&L account we are going to credit here this item we have already done. 16th point, amount standing in revaluation reserve. It should be credited to the P&L account. But withdrawal from revaluation reserve, here asset is not sold. There in positive adjustment, you see asset has been sold. Sorry, positive adjustment, yes. Their asset has been sold on disposal. I have said to you, on disposal. Okay. But here if you see, directly I am withdrawing from revaluation reserve. Sir, if you create revaluation reserve, whether we are allowing depreciation on revaluation? Tell me. No. The same way, if you withdraw from revaluation reserve, we should not tax it. So if any sum is credited to P&L account by withdrawing from revaluation reserve, because on revaluation depreciation we are not allowing, no sir. That's why withdrawal from revaluation reserve we should not tax it. Okay, withdrawal from reval, sir, this is negative or positive adjustment? Negative. Negative means it's already credited to P&L. That amount we are reducing. Why we are reducing? Because we are not allowing depreciation on revaluation at all. That's why any withdrawal from revaluation. Sir, upon disposal of asset, if amount is credited, upon disposal of asset, if it is created withdrawal from revaluation reserve, whether I have to reduce that item? No need. Here asset is not sold. Before the asset sale, if we withdraw from revaluation reserve, what I have to do? I have to reduce. Because already on depreciation, that's why it was given. Because it has not exceeded the amount of depreciation. Already on depreciation, we are going to add it back. That's why withdrawal from revaluation reserve, we should not tax it again. Is it clear? 17, 18, 19 we will discuss in the AS adjustment, sir. Now if we come back to the theory, MAT number 1, applicability. Tell me, it is applicable to which companies? All companies, including foreign companies. It is applicable for SED units also, they are saying. Sir, SED unit profits section 10A exemption, no sir. I said all exempt incomes were exempt, but except 10A. That means on SED units, we levy MAT. That is point number B. Income derived from any business carried on services rendered by entrepreneur or a developer in a unit or SED. That means SED units, even though they claim exemption under section 10A, they are liable to pay MAT without such exemption. Is that first part clear, sir? Next, second part. MAT is not applicable for which companies? Life insurance companies. Because life insurance companies, what is the normal tax rate? 12.5% only. Business, life insurance business companies, not all insurance companies are life insurance companies only, which were in the business of life insurance. On that profits tax at the rate 12.5% only. How can we levy MAT 15%? Always MAT only will be higher. That's why. Okay. So next, second exception is companies opting presumptive incomes. 44B, BB, BBA, BBB. So remember that 10%, 5% profits we are offering. So for companies who are opting those sections, what is not applicable? MAT is not applicable. These exceptions many times they have asked, sir. For which companies MAT is not applicable? Should not say simply foreign companies. Foreign companies opting presumptive incomes. Next, sir, this MAT total how many adjustments? 38. Whether SSE has done those 38 adjustments right, correct or not, auditor has to check and he has to give report in form number 29B along with return of income. That means at the time of filing return itself, auditor has to submit this form 29B also. In ITR form, this form will not be, sir. Separately we have to file. Auditor will have a separate login. So since you are all article students, you remember auditor will have separate login to file 3CB, 3CD report. There only we are going to file form number 29B. Next. What is the MAT rate, sir? 15%. But if the company is having unit in IFSC, IFSC stands for International Financial Service Center, where non-residents come and take the services. Sir, assume IFSC is a building, like a shopping mall. IFSC is a building, let us assume. In that IFSC, if company has a unit, sir, who will take services from IFSC? Only non-resident. Exclusively for non-resident benefit only IFSC has come into existence. So if any company has a branch in IFSC, they provide services to non-residents. No, that means foreign currency will be realized. We have to encourage on that profit. What is the MAT rate? 9%. Okay, so we have to learn some, we have to practice some problems on this computation of MAT, and we should also learn adjustments relating to India. There are 6 adjustments, and we have to learn adjustments relating to business trust. So those are all items we are going to discuss in further session. So thank you very much.